Chapter 7, Liabilities. With Chapter 6, we finished up the asset side of the balance sheet. Chapter 7 will discuss the liability section, and then Chapter 8 will cover equity. As you might guess from there being only a single chapter, there's a lot less diversity of liabilities than there is of assets. Even so, there's still quite a bit to know about liabilities, and this lecture will actually go off-roading a bit to cover some important things that aren't explicitly discussed in the text. So let's start at the top. We know that one of the primary uses of the balance sheet is to assess short-term solvency, and so we break out the current assets and current liabilities from their non-current counterparts. To recap, what makes a current liability current? Well, it's a liability, of course, which means that it's a probable future economic sacrifice, and it's current, which means it's going to be satisfied with current assets. That's probably a tighter definition than we need, and it's easier to think of as coming due within the next year or operating cycle, whichever is longer. We've already seen quite a few current liabilities as we were going through our Chapter 3 material, as well as in the inventory chapter when we were making purchases. First is our accounts payable, and those come about when we make a purchase but don't pay for it with cash. Debit purchases, credit accounts payable, and then of course when we make the payment, the payable goes away. Debit accounts payable and credit cash. Nothing terribly exciting about that. Other things that we have to be aware of are these employee expenses. You've already seen this in your Ronco project. Ron owed his employees wages at the end of the period, and he was going to pay them the following month. What's the point of this? Well, as usual, it comes back to matching. We are recognizing future cash flows as expenses today because today was when the revenues were generated. But it's not just the wages. It's all those fringe benefits they earn over time. Let's say we have an employee who gets a week of vacation after a year of service and they get paid $15 an hour. After that first year of service, we now owe our employee some money. 40 hours at $15 an hour, we now owe our employee $600. How are we going to recognize this? Well, we'll debit vacation expense, that will roll into wage expense on the income statement, and we'll recognize a liability for the $600 that we owe them. Why do we do this? Because when they take the vacation time next year and we write them that check, how much revenue will they generate? None, right? They earned that vacation time this year by coming to work and generating revenues, and matching tells us that we should record that expense right now. Depending on what sort of expected turnover we have and the materiality of the amounts, we might actually recognize $50 of this a month so that the expense gets into the right period if we have a year end in the middle of this first year of service. Regardless, the goal is to recognize the expense not when the check is written, but when the work was done. Let's now fast forward to when they take that vacation time, and let's assume that their wages have increased by a bit because they got a raise. Now, we could backdate it and give it to them at $15 an hour, but we'd be total bastards if we did that, so let's pay them the extra 50 cents when they're on vacation. That ain't gonna kill us. When we write that check, it's going to be at 40 hours times $15.50 or $620. So we'll credit cash for $620. But the liability can only be debited for the $600 that we had previously recognized. So what do? Well, we'll plug the difference into wage expense. We had to estimate, and we did our best. If our estimate is wrong, no big deal, just carry on. Just like with our fixed assets in Chapter 6, there's no retroactive treatment when we change an estimate. Next on the list is the advanced collection. Here is money that we're paid up front by someone, and we don't deserve it. Again, we've already encountered one version of this, our unearned revenues. Our customers gave us money, but revenue recognition rules tells us that we're not allowed to call it revenue until we've done the work. So we debit our cash, but we're left crediting a liability until we've done our share of the bargain. Once we've done so, we'll debit the unearned revenue and close it out, and we'll credit the revenue, which winds up on the income statement. We have a net of a debit to cash and a credit to revenues. We've just separated the revenue recognition from the cash receipts. This is a remarkably common sort of transaction. When customers pay for magazine subscriptions, this is what they do. They've got a big honkin' liability, and as they ship each issue, they get to recognize a little chunk of revenue. Season tickets for sporting events or the orchestra, you pay for the season up front, and doing the work means putting on the event or the concert. Airline tickets are unearned revenue. If the plane doesn't fly, they have to give you back your money. Insurance contracts, we saw that with Daveco back in Chapter 3. One person's prepaid is another person's unearned revenue. The bottom line is that just because we've been paid doesn't mean that we've got revenue. Taxes collected on behalf of the government are absolutely a liability. This includes sales tax, in which someone buys something for $100, but we charge them $105. The cash coming in is $105. We only recognize $100 of sales. That extra $5 is a liability to the government. Also, there's our payroll taxes. Let's say we have wage expense of $1,000. Certainly the check won't be for the full $1,000, because there's federal income tax withholdings, and state income tax withholdings, and FICA, and all of those other things like 401k and flex spending accounts. So the actual check that we write to the employee is itty-bitty. And if you're an entrepreneur in business with a partner or with an office manager, this is something you absolutely have to be sure is happening. When you hear about someone embezzling at some small business, this is often what the problem is. The office manager writes the payroll checks to the employees, and rather than submitting the withholdings to the government, they just pocket the money themselves. And the horrible thing about this is that the government doesn't care if you were screwed. The government wants its money. So in these cases, not only did they steal from you, but also the business is going to have to find the cash to make those payments for those tax withholdings. Oof, insult to injury. Interestingly enough, if you're looking to embezzle, I would suggest you become an office manager for a doctor's office. From my own personal experience, these people have no idea how to even write a check, let alone make sure they're not being stolen from. My wife doesn't even know how to use the ATM. And when we lived out in Indiana and she was doing her residency, she spent one day a week at a local clinic near our house for outpatient training. She came home one day upset that the office manager, who had been working there for a gazillion years and the families were friends and stuff, and they had been stealing from the practice, and all the employees were devastated. And the crazy thing is that they hired a guy to come in and clean up the books, and 6 months later they caught him stealing from them too. So it seems that office manager for a doctor is a great job for people who are looking to steal. You heard it first here. Customer deposits. This is different from an unearned revenue, and we'll see why in a moment. Say you move to your new apartment, and the landlord wants first month, last month, and 1 month's security deposit. Rent is $500 a month, so we're writing a check for $1,500. What does the landlord record? Well, he just cashed that check, so he's going to debit cash for the full $1,500. And what does he have to do with this? Well, what's it for? First, there's the unearned revenue of $1,000 for the 2 months that you'll be living in the apartment. But the other $500 will get its own account, and we'll call that deposit or deposit payable, which is also a liability. Now, why do we break these out? What's the difference between these two types of liability? Well, what do we know about unearned revenue? Someday, it'll grow up to become earned revenue. But what do we know about this $500 down here? In theory, he's going to have to give you that money back when you move out. In reality, he'll nickel and dime you until he's used up the entire deposit, but in theory, that's going to be a check that he's got to write. So while these are both current liabilities, they have very different implications for the future. Unearned revenue tells us about future revenues the firm is going to generate. The deposit is actually just a payable. At the end of the month, what does he get to do? He'll recognize the fact that he's earned a month's rent, and he'll recognize that as revenue. Now, since we're in Maine, let's say our hockey player friend Jean-Claude, since he's Canadian of course, gets wicked drunk and punches a hole in the wall with his hockey stick. Because you know, when you're on that protein powder stuff that athletes take, that doesn't mix so well with booze. When I was a freshman in college, my RA and his roommate were both in naval ROTC, and so worked out a bunch. And said roommate was all over that andro power crap that you get at GNC that makes your back break out and hair grow on your shoulders. And boy, was he an angry, angry drunk. Egad. So, Jean-Claude has just punched a hole in your wall, and it costs $100 to get it patched up. What does the landlord book? Well, he just wrote a check for $100 to the drywall guy, but rather than debiting maintenance expense, he's going to debit that deposit. He no longer owes you $500. He only owes you $400 because you forfeited that first $100. Thanks, Jean-Claude. Bastard. Okay, we've got one more thing to look at on our current liability side. Current maturities of long-term debt. Let's say we've borrowed $10 million and we're not going to have to pay it back for a number of years. But the bank has decided that they don't want to wait until the last minute to find out if we're going to be able to pay them back. So the note is structured in such a way as to require it to be paid back in chunks. And here we are on December 31st, and our first payment is due next year. What do? Well, for balance sheet presentation, we will break that note up into its current portion and its long-term portion, even though the actual note payable was a single financial instrument. Whatever portion is coming due this coming year is current, the rest will be non-current. In addition to this, in the footnotes, we are required to disclose the payments that are going to have to be made for each of the next 5 years as a supplemental disclosure. So our footnote will say that we're going to pay $2 million this year, $2 million in 08, $2 million in 09, $2 in 10, and $2 in 11 and beyond. This can be very helpful because let's say that the payment is due on January 1st. If that's the case, and today is December 31st, 2006, this is technically non-current. But what's the difference between 365 days and 366 days? The technical answer is 1 day, but the intuitive answer is not a whole lot. This disclosure gives the users a better idea of what payments are coming down the pike. Regarding the classification of long-term debt as current versus non-current, there is one little quirk. Because of the time delay between the end of the fiscal year and when financial statements are published, we are allowed to classify that amount coming due as non-current if, as of the end of the fiscal year, we showed the intent and the ability to refinance. What does this mean? Well, we had to have plans in place by December 31st to show intent. And showing the ability means actually pulling the trigger on the refinance. If we meet both criteria, we can classify the debt as long-term, even though it was technically current on December 31st. So there's current liabilities for us. Next topic is contingencies. The book only spends a couple paragraphs on this, but I'm going to expand upon it a bit, because this really is a big deal, and it's worth your having a good idea as to how all this stuff works. What's a contingency? It's something that's contingent upon some other outcome, something that's not entirely, or perhaps at all, in our hands. A good way to frame the contingency discussion is in terms of a lawsuit. We are the plaintiffs or we are the defendants in a lawsuit, and there may be damages awarded. The gain or loss that we would recognize is contingent upon the outcome of the jury deliberations, and then all those years of appeals that these things invariably go through. If we are the plaintiffs and they find in our favor, ka-ching, ka-ching, we've got a gain. If they don't, we get nothing. If we are the defendants and they find in our favor, huzzah! And if they don't, we're going to be writing a check and taking a loss. But we know it's out there, and we know that full disclosure is one of the hallmarks of a good accounting system. So what do we do when we know that there's this thing floating out there, but we don't know for sure how it's going to play out? Well, the first thing we do is we break it into a gain situation and a loss situation, because conservatism tells us that we treat gains and losses differently. Then we break it down into how likely we think the contingency is going to be to materialize. How do we assess that? We punt and we let the lawyers tell us. Let's start on the loss side. Someone is suing us because we did something horrible and we might have to write some checks. If we're facing a contingent loss, and it's both highly probable and we can estimate it, then we're going to record the loss on the income statement and we're going to book the liability on the balance sheet. We will debit legal liability loss and we will credit the contingent liability. If, however, we are unable to estimate the amount, then we can't put it in the financial statements due to the monetary unit assumption, so we'll just disclose it in the footnotes. Where does the estimate come from? Again, ask the lawyers. When Vioxx started killing people, and the Toyota automobiles had those sudden accelerations that got a bunch of people hurt, and BP fucked up the environment for the entire southern coast of the United States, this is what we're talking about. We're going to have to pay. It's just a question of how much. There's conservatism at work. Our second tier is reasonably probable. If it's reasonably probable, regardless of whether or not we can put a dollar value on it, we will disclose it in the footnotes, and that'll be that. What's the difference between reasonably probable and highly probable? You got me. Presumably the lawyers know. If we have a remote chance of a loss, we're going to ignore it. These are the nuisance suits that we face. People sue us, hoping that we'll just throw some money at them to make them go away. Like the guy who picks up the lawnmower to trim the hedge and cuts his hands off. You have to figure someone must have done that, since there's that warning on the side saying don't do it. Or perhaps the McDonald's coffee crotch woman. Here's the woman who bought the cup of coffee at the drive-thru, puts it between her legs, and then spills it with hilarity ensuing. Or maybe not so much. She sued McDonald's, but what jury in the world would award her $6 million in damages? Well, if you were to answer an American jury, you'd be right. But I can guarantee that when the McDonald's financial statements were being put together, this was put in the same bin with the wackos who claim they found a finger bone in the Big Mac. Now, it is worth keeping in mind that when we talk about these contingent losses, our goal is not to incriminate ourselves. So we are going to be vague when we can be. We are going to uniformly say that we believe that we are right and we are defending ourselves vigorously. And if we have to book a loss, we'll say that we still think we're getting a raw deal. We don't want the plaintiff attorney to walk up to the jury and say, "Look, here's the annual report, and they say they owe my client $50 million. We need to be very careful about how we phrase this stuff. We'll also not disclose anything for which there has not been action taken against us. So, we just released a bunch of waste into the river. Oops. We know that if the EPA finds out about this, we're going to be in a world of shit. So we're not going to put in the footnotes, "Oh, by the way, guess what we did? Yoo-hoo!" Or remember Marge, our petty cash person from a couple classes ago? Well, it turns out she was stealing from us. Have you seen The Untouchables? It's starting to get a little old now, but it's the only Kevin Costner movie worth watching. So De Niro is playing Al Capone, and he's got all his guys around a table, and they're all in their tuxedos and stuff, and he's talking about baseball and using it to promote teamwork between his men. And he's got a bat. And all of a sudden, bam, 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 he bashes this guy's head in, and blood is splattering everywhere, and all the other people at the table are looking on in horror. Bam, bam, bam! Well, we just did that to Marge, because she was stealing from us. And that's not very good teamwork. And then we buried her under the floorboards. Oh my God, Marge, what did I do? We're not going to put that in the footnotes either. The "don't look under the floorboards" contingency. But once a claim gets filed against us, we've got to start disclosing this stuff. Let's look at the contingent gain side. In this case, we're the ones who might come away with some money. If we're on the winning side and we think it's highly probable, we might disclose this in the footnotes. Maybe. We're definitely not going to record it in the financial statements, though. Anything less than a slam dunk, it doesn't even go in the footnotes. The reality is that there are plenty of venues for us to talk about what we might win, such as press releases, news conferences, conference calls. These things will be kept out of our financials. Now, while a lawsuit is a nice way to conceptualize the idea of a contingency, there are other more day-to-day items that we're going to be encountering. One of these is the warranty we offer our customers. We sell a product, and the product comes with a warranty. It's not unreasonable to believe that at least a part of the decision process that led the customer to us, as opposed to someone else, has to do with our warranty. I bought some tools at Sears because they're guaranteed to last forever. That's why I went there as opposed to Home Depot. So there's a warranty cost that's floating out there. The warranty is contingent, though. It's contingent on two things. First, the product has to break, and second, the customer has to file a claim. Not all of our products are going to break, and of those ones that break, some of our customers will just shrug their shoulders and throw it away because it's not worth it. You know those Snuggies that were all the rage? My wife bought them for my kids. When they wear out, I'm not going to go to a lot of hassle trying to get them replaced. I'll just toss them in the trash can when no one is looking. So let's look at our company that sells chainsaws for $250 each. Each chainsaw comes with a 2-year warranty, and based on past experience, we think it's going to cost us $15,000 to pay for all the repairs on the returned ones. That's a contingent liability. It's highly probable that a subset of our chainsaws will break and will be returned for service. During the current year, we actually spent $4,500. So how do we reflect these things in our financial statements? Well, of course we record the sales, and there those are. But we also need to recognize this highly probable, estimable warranty cost. What should we record for our warranty expense? Matching and conservatism both point to recognizing the full $15,000 of expense in the current period, even though we only spent $4,500 in cash. Because let's say we decide to never sell another chainsaw again. We'll still be on the hook for the other $11,500 of repairs, even though we won't be generating revenues from chainsaw sales anymore. We have to recognize the full amount now. So we debit the warranty expense for $15,000 and we credit accrued warranty liability. So we have on the books that we owe our customers $15,000. Not $15,000 in cash, but $15,000 of work that we've promised them. And then, as we spend money to fix the chainsaws, we are fulfilling that obligation to our customers and therefore paying down the liability. I've credited cash, etc. right here to represent that not all $15,000 needed to be spent in cash. We might have had to replace parts with new components from our raw materials warehouse. The cost of those parts belong in our estimate just as much as the technicians' salaries. Okay, so now let's have some fun with this. Let's take a look at our accrued warranty liability T account, and let's book our $15,000 in 2000 X1 and do the service in X1. So at the end of 2000 X1, what do we have on the balance sheet? $10,500 of liability. We thought we owed our customers $15,000, and we've begun to make good on that promise, but we expect to have to keep writing checks for another year and a little bit. And this is of course subject to change. You can bet that Toyota had a warranty liability set aside for their cars, and after that acceleration debacle that resulted in all those recalls in 2009 and 2010, I have no doubt that they had to revise their estimate way upward. Let's say that no warranty claims come in 2000 X2, so we don't incur any costs in X2. We're still going to say that we have $10,500 for our liability on the balance sheet, since the warranty is going to continue until at least a part of 2012. But let's say that we don't spend any money to service warranties in X3 either. At the end of 2000 X3, what should be on our balance sheet for the warranty liability? Our accounting system currently tells us that we've got $10,500 as what we owe, but how much do we really owe? Zero, right? By the end of 2000 X3, the 2-year window on all purchases back in X1 will have expired, which means that our customers have missed the boat. If their chainsaw breaks now, they have to pay to get it serviced. So our balance sheet ought to say zero. But the accounting system says $10,500. We've been here before. How do we get an account to have a zero balance when it's got a credit for $10,500 in it? Well, we debit it for $10,500, of course. So, if we debit the account for $10,500, we've got to credit something. And what are we going to credit? Well, we're going to credit some sort of gain. What we call it doesn't really matter, so long as we recognize that it's an increase on our income statement in the current period. Note that it's a gain in the same sense that we had a gain on the disposal of the fixed asset. It's simply a true-up between what we estimated the loss would be and what the loss actually turned out to be. So here's the fun part. What if management knew all along that they weren't really going to spend all $15,000? What have they done? They've just moved income from one year to the next under the guise of conservatism. They reduced their net income by $15,000 in X1, and they increased their net income by $10,500 in X2. This is just like what we did with our lower of cost or market back in the inventory chapter. From a practical standpoint, what is to keep the managers from doing this sort of thing? Certainly there's ethics and responsibility and the like. Assume that management doesn't have any ethics. What's to keep them from doing this sort of thing? The same people who are supposed to keep them from any financial statement misstatement, the auditors. And you know what? There isn't an auditor in the universe who won't let this slide and let them book that expense. Why? Because of conservatism. Because if the auditor tells them to lower the expense and things turn out worse than expected, the auditor gets sued. So the reality is that this sort of thing happens all the time. We see it most often in the context of restructuring charges. Here we are in a company and things aren't so good. So what do? We come up with a plan to turn things around. This means buying out some employees to reduce labor costs. This means closing some factories that are making underperforming products. And both of these things cost us money. Once again, conservatism steps in and says if we have a probable loss, and we do, and the amount of the loss is estimable, and it is, then we book the full loss now. So distressed companies will end up recording ridiculously large losses for restructuring charges, so that when the checks get written for the buyout, and when we sell our equipment at 50 cents on the dollar, the loss has already been recognized. But let me ask you something. Say your business has just lost $100 million, and you weren't fired. Do you think you'd be fired if you lost 105 or 110? Probably not. It's like when you move to Maine and people say, wow, that's way up north, and you say, oh, I'm actually living in Orono, which is only halfway up the state, and they say, it doesn't matter. Once you cross the border with New Hampshire, you're wicked far north. So what many companies do is pad this restructuring liability on purpose so that they can reverse the liability into income with a revised estimate when they need to. Someone studied the timing of these reversals, and it was uncanny how often the reversal happened in time to coincide with a period in which the firm was going to miss an earnings target or were going to report a loss for the period. I actually experienced this sort of thing in my professional career. I was auditing the liabilities section of a balance sheet, and there was a line for miscellaneous additional accruals. And this was for about $300,000. Total net income for the period was $1 million or so this was a material amount. I went to the accountant and asked what it was, and she looks at me and says, well, we had a bad year a couple years ago, and Mr. Jones didn't want to have that happen again, so he told me to book an extra $300,000 of expense this year for us to take back into income if we needed another year. And I looked at her, stunned, since I would have expected her to lie through her teeth about it to me. So anyway, I go back to the audit room and propose my adjustment to the books, essentially reversing out the expense and the liability. When the partner came to review the work papers, though, he was troubled by this, and his solution was to declare that the allowance for doubtful accounts was too low for the quality of their receivables. By how much, you might ask? By $300,000, of course. So he says we should debit bad debt expense and credit the allowance for $300,000 each. When you put that entry together with the one I said needed to be made, it was a wash, so we and the client agreed to record neither. Next topic, long-term debt and bonds. The way we account for notes payable and bonds payable are essentially the same, just with different names. So, while the following discussion will be all about bonds, if you substitute the word note in there, you'll be in the same place. So what is a bond? Well, a bond is a way of securing debt capital, just like going to the bank to borrow money. The idea behind a bond, though, is that rather than going to a single bank or a consortium of banks to borrow all $20 million that we need, we have chopped it up into little debtlets so that an individual lender can get in on the transaction for as little as $1,000 or $100 or maybe even $50. Unlike bank debt, the bonds are easily transferable, so if someone wants to cash out, they can, and the risk of default is spread out over a larger population of investors. The bonds are issued in much the same way as an initial stock offering, with an investment banker acting as middleman who matches the firm with willing investors. There are several common types of bonds that you might run into in your careers or in the popular press, so it's worth reviewing them here. The first is the asset-backed bond, which is similar to the mortgage we have on our houses. If the company should default on a loan, then there are specific assets pledged to the lender as collateral, and those assets will go to pay off that specific debt, even if other creditors are getting squat at bankruptcy. The other alternative is what we call a debenture bond, which has no such protections. You hope that the company will be able to pay you back, and if it doesn't, then you get in line with everyone else. Which of these two would you expect to have the higher interest rate? The debenture bonds, of course, since they are taking the extra risk. That's supposed to be a star. There's also such thing as a convertible bond. What is it convertible into? Typically shares of common stock. What good is it? Well, the investor invests in a relatively low-risk investment, compared to stock that is, but if the stock price takes off, they can cash in on the upside potential. So it's a way to sweeten the deal for the potential investor. On the other side is the callable bond, which gives the firm the right to repay the bond early at its discretion. There are certainly other things we could see, but these are the ones that you're most likely to run into. So how do these things get reported on the balance sheet? Well, let's say that Daveco issues $100,000 of bonds with a 10-year maturity, and it pays 8% interest payment each year. We're going to treat this just like any liability. We're going to record our cash going up with a debit, we'll record the liability with a credit, and we'll go on our merry way. That was easy. Though in reality, it may not be as easy as that. So, we're paying 8% on our bond. What if other companies out in the marketplace with risk characteristics similar to Daveco are offering 10% return on their bonds? What does that mean to Daveco? It means that Daveco is going to have an awful hard time selling its bonds. In fact, it probably won't be able to. Because if you're an investor and you have the choice of earning 10% or 8% for the same amount of risk, what are you going to do? Get the 10, of course. So to make our bond competitive, we're going to offer it at a discount. That is, we will accept less than the face value today in order to increase the return that the investor earns. Rather than receiving $100,000, we'll only get $87,711 in cash. We're going to do something a little funky here, though. We're still going to record the bond at its face value of $100,000, and we'll plug the difference into an account called discount, which is a contra liability. Just like with how we subtracted accumulated depreciation from our asset to get a net fixed asset value on the balance sheet, we'll subtract the discount from the bond payable account to get a net liability value on the balance sheet. And what is that net liability? Well, it's $87,711, the amount of cash we just received. What if it turns out that all those other firms are offering only 6%, and yet here we are offering 8%? What do you think is going to happen now? Are people going to be interested in our bond? Of course they are. And in fact, they're going to be so interested that a bidding war will ensue. The price of the bond will get bid up so that when we issue this thing, we'll actually end up getting more cash than the $100,000 face value. We'll get $114,719. This time, we'll use an account called premium, which we'll add to the bond payable account rather than subtract from it. Now here is where the book leaves off, which in my opinion is insufficient. So we're going to do a little off-roading on a little digression on what is called the time value of money. Let's say that you have no immediate purchasing need, and I offered you $100 today or $100 a year from now. Which would you prefer? Well, the money today seems like a pretty good deal. Why? Well, because we could take that $100, we could stick it in the bank, and at the end of the year, we'd have $103 instead of $100. And here's the fundamental premise of the time value of money, that stable dollar thing that we talked about in class 2 is a load of crap. $1 today and $1 a year from now are not the same thing, and we shouldn't treat them as being so. So this leads us to the definition of present value. Present value is the value in today's dollars of some future cash flow given a certain interest rate. In our example above, $100 today is the present value of $103 in 1 year if we can earn 3% on our money. In economic terms, we are indifferent between receiving $100 today or receiving $103 in a year because they are identical. If you give me $100 today, I'll stick it in the bank and withdraw $103 in a year. If you give me $103 in a year, I'll have $103 in a year. I end up in the same place in both conditions. I'm indifferent. Now, why is this an important concept? It's important in two different contexts. It's important from a business standpoint because we'll be making decisions that require an understanding of this relationship. And what I mean by that is, let's say that we want to expand to a larger facility, or invest in a new product line, or even hire a new employee. We'll be making cash outlays today in return for profits in the future, possibly over a long time. That is, say we want to spend $100 million today on a new factory, and this will give us a return of $10 million a year times 11 years. How do we know if that's a good deal? We know that the $10 million that we earn next year is worth less than $10 million today. We know that $10 million that we earn in year 2 is worth less than $10 million today. And we know that the $10 million we earn in year 11 is way less than $10 million today. So how do we decide if spending $100 million today is worth the $110 that we'll earn over the next 11 years? By calculating present values. Given an interest rate, we can say next year's $10 million is worth X in today's terms. And we can do the same thing for year 2 and for year 3, all the way to year 11. And when we add them all up, we can calculate in today's dollars the profits that we're going to earn on this investment. And we compare that to the $100 million that we're spending today. If the total of those profits are less than $100 million, then it's a bad idea and we don't invest. If the total of these profits are more than the $100 million, then we really are making money on the deal, and we will invest. And that's the concept of net present value. It's also important from an accounting perspective since we use this framework to establish values of many of our long-term liabilities, including leases and bonds, and it's used in valuing some long-term assets as well. So let's take a look at how the math works. It's easiest to start with future value, which is present value in reverse. We've got money today, and we want to know how much money it will grow to at some point in the future, given an interest rate. In a single year, that's simple interest. We see the $1,000 becoming $1,100 when we earn 10% for 1 year. Down below, if we have multiple periods, that becomes compound interest, and we see that our $1,000 grows to $1,100 after 1 year. We earn 10% on not just the original $1,000, but also the $100 of interest we earned in year 1, and that grows to $1,210 at the end of year 2. There's a mathematical formula here we can use to save us the math, so we can just do it in a single calculation, no matter how many periods we need. The future value of $1,000 in 2 years at a 10% interest rate is $1,210. Now that we can see how the math works, and we can agree that $1,000 today and $1,100 in 1 year is the same, and that $1,000 today and $1,210 in 2 years is the same when we've got a 10% interest rate, let's see it in reverse and calculate our present value. We once again have formulas, and these formulas will allow you to take $1,100 in 1 year and bring it back to $1,000 today. And we can take that $1,210 in 2 years and bring it back to $1,000 today. On the next page in your notes, I've excerpted a present value table. This table lists out all the values you would get from the present value formula if you put in 1 for x for any given combination of n periods and I interest rate. While our nifty financial calculators and Excel will do these calculations for you, I like to use the tables in class because it helps solidify the intuition behind what we're doing. This is the present value table, so we'll take our future cash flow, however much it happens to be, and multiply it by the table factor for the correct combination of time and interest. This will give us the value in today's dollars of that future cash flow. So, for example, say I told you I'd give you $100 a year from now, and we want to know what that would be worth today. Well, let's assume that you would be able to invest the money at 1%. In that case, we'll multiply our $100 by the table factor for n is equal to 1 and I is equal to 1, and we'll see that $100 a year from now is the same as $99 today. And just a quick bit of math proves this. What's 1% of 99? 99 cents. So if we put our $99 into the bank today and withdrew it in a year, we would be able to pull out $99.99, which is within rounding distance of $100. If I told you that I'd give you $1,210 to you in 2 years, and you can earn 10% on your money, we would come over here to n is equal to 2, I is equal to 10, and we would multiply the $1,210 times our 0.826, and that'll get to the $1,000, which was the example we used on the formula pages. Now let me highlight a couple relationships. As our horizon increases, our table factors start to go down. We know that $1 next year is worth less than $1 this year. $1 10 years from now is worth even less. Also, as the interest rate increases, the table factor goes down as well. If you can earn 10% on your money, $91 today is worth $100 in a year. If you can only earn 1% on your money, that $100 in a year is worth only $99 today. It's fascinating to see the compounding effect of a high interest rate and a long period of time. If you were able to earn 10% return on your investment and you were willing to wait 10 years, you would need only $38.60 in the bank today to get the $100 cash out. If you've ever been to a personal finance seminar or spoken with a personal finance professional, they often highlight for you the power of compound interest on your investments. The longer your horizon, the more your money will grow over time because you earn interest on your interest on your interest, etc. Why don't you take a moment now to pause the recording, open up an Excel spreadsheet or whatever program you use, and verify this for yourself. In cell A1, put $38.60. In A2, put equals A1 times 1.1. Then, copy cell A2 down to cell A11, and you should find $100 at the end. Did it work? You should have come up with $100.11. That 11 cents is due to rounding, since we started with only 3 decimal places down here, and that could actually extend quite a bit further. So let's take a look at some uses of present value in the real world to try to get us thinking about more than just the math. How are we going to use this stuff? Well, let's say we own a landfill in Hamden, where I live. And we know that when that last truck has dropped off that last trash bag, we can't just walk away. We're going to have responsibilities associated with this landfill for a number of years to come, as we cap it and monitor it and turn it into the golf course that they always promise landfills will become once they've been closed. And our engineers have told us that it's going to cost us $1 million to get this thing decommissioned. Now, the town of Hamden, being rational and well-meaning folks, are concerned that we just might skip town when we've cashed that last check, leaving them with a big stinking pile of big stinking things to clean up. So what do? They make us put some money aside in an escrow account so that they know the $1 million will be there when it's needed to pay for the shutdown. So how much money do they make us put aside? Certainly not the whole $1 million, since it'll have time to grow. How much will depend on the time between now and when we need the money, and the interest rate we can expect to earn on our investment. Let's look at a few options. I've chosen 2 interest rates for us to use and 3 time horizons. We can either earn 6% or 10%, and the money will be sitting and growing for either 20 years, 30 years, or 40 years. So, on to the table to find our answers. Here's another chunk of that same table, with a considerably longer horizon included this time. Here we see our 6% and our 10% columns, and to calculate how much we would need, we'll go down the column here to discover that at 20 years and at 6%, our table factor is 0.312. We multiply this by the $1 million, and we discover that if we put $312,000 into the account today, it'll grow to be $1 million in 20 years. And if you still don't believe me, repeat the Excel thing with this, making it 1.06 and 20 periods instead of 10. And at 40 years, it's only 0.097. Looking at over this side, on the 10% column, 20 years is 0.149, and 40 years is 0.022. Here we are back to our example, but with the numbers filled in. The relationship between the values should be intuitive. We need $312,000 if we earn 6% over 20 years, but we only need $22,000 if we can grow it at 10% for 40 years. We're earning a higher return, and we're earning it for longer. Of course we won't need to put as much into the account. And look at that. $22,000 today, earning the stock market average return of 10% over 40 years, and we got $1 million at retirement. There's the personal finance guy jumping up and down about compounding. Get started early with your Roth or your 401k or whatever. Another way to look at the present value data is with an annuity. Now, this is just a time-saving procedure that allows us to calculate the present value of future cash flows when we have multiple payments of the same amount, like our mortgage on which we make the same payment every month. There are 2 different types of annuities: ordinary annuities and annuities due. The little chart in your notes shows you the difference. An ordinary annuity is a series of payments at the end of the first period, whereas an annuity due is a series of payments beginning today. The math is a little bit different, but the concept is the same. The upshot of this is that no matter what the stream of cash flows look like, we can figure out what it's worth in today's dollars given a certain interest rate. I could draw a timeline with a bunch of wacky cash flows, like this perhaps. Say $50,000 here, and $20,000 here, and $100,000 a year for 3 years here, and maybe even a negative $25,000 today. So long as we've got an interest rate, we can calculate exactly what this stream of cash flows here is worth in today's terms. So let's do an example that lets us see the annuity calculation at work. I play Powerball every so often. Why? Because I'm not very good at math. You can probably guess that I haven't won yet. Why? Because I'm still teaching. So the way that Powerball works is that when you win, you get to choose between receiving the jackpot in the form of an annuity over 20 years, or you can elect to take a lump sum cash payment today. And of course, that lump sum is quite a bit less than the stated jackpot value. What if we managed to win $100 million? What would be the value of the cash option? It would be the present value of an annuity of $5 million a year for 20 years. That's what. So let's turn to another present value table. This time, it's the present value of an ordinary annuity. You'll note, of course, that these numbers are all bigger than 1 since we've got multiple payments. This 20-period row right here involves 20 payments. And there's nothing magical about this. It's just a time-saving tool. If you were to look at a present value of a single sum table and add up the first 20 numbers in any column, they would sum to the numbers that you get in the 20-period row. Because the present value of an ordinary annuity can be reduced to the present value of a payment in 1 year, plus the present value of a payment in 2 years, plus the present value of a payment in 3 years, and so on. So here we have our 20-year row, and the present value of that $5 million annuity will depend upon the interest rate that we use. If we assume that we can earn 6% on our annuity, the cash option will be $5 million times 11.47, or about $57 million in change. If, on the other hand, the expectation is that we can earn 10% on our money, over here we'll multiply that $5 million by 8.514. Here we are with the table filled in, and there's the $57 million and the $42.5 million for the ordinary annuity. Look at the annuity due column. Here we have a payment that starts at the beginning of the period rather than the end of the period. Why is this column more? Because a payment today is worth more than a payment a year from now, and a payment a year from now is more than a payment 2 years from now, and so on. So it really is important to be aware of the timing. Okay, one more example for us to do. Assuming a 10% rate, let's calculate the present value of $100,000 in 10 years. $100,000 times our table factor with n is equal to 10 and I is equal to 10. This yields 0.38554. I got that from a different table that actually has 5 digits. Therefore, the present value of the $100,000 is $38,554. Assuming a 10% rate, let's now calculate the present value of an annuity of $8,000 a year for 10 years. $8,000 times our annuity table factor with an n is equal to 10 and as I is equal to 10. This yields a table factor of 6.14457 for a present value of $49,157. When we put these together, what have we done? We've got $8,000 a year for 10 years, followed by $100,000 at the end of 10 years. What does this sound like? That sounds to me like the cash flows associated with $100,000 of bonds that pay an 8% annual interest payment. If we add the two present values together, what do we get? We get $87,711. And where did we see that number before? That was what I told you we'd receive for the bond back before we took this time value of money detour. Neato. So now let's go back to our note and see what happens after we borrow the money. Here we were paying 8% in a 10% world, and therefore we had to issue our bonds at a discount, accepting only $87,711 for our $100,000 face value note. We plugged the difference into our discount account, which means that we've got $87,711 of their money, and our balance sheet says that we've got a liability of $87,711. Those jive. Excellent. And then the end of the year rolls around, and we're required to make our first cash payment. We are also going to take this opportunity to recognize interest expense on the income statement. Let's think about how much interest we owe our lenders for the money they gave us. The deal is that they loan us their money, and we pay them interest on the money we borrowed, right? How much of their money do we have? Not $100,000, only $87,711. And what do we and they and the rest of the market believe is a fair rate of return on a loan to our company with our risk characteristics? 10%, right? So if we've got 87,711 of their money and 10% is a fair return, it stands to reason that the interest expense we face and the interest revenue they get to recognize will be $87,711 times 10%, or $87.71. Now let's look at the journal entry, because it's really pretty cool how all this works out. First, we know that we've got $87.71 of interest expense because we just did that calculation. We debit expenses, so the debit to interest expense is for $8,771. We have to write a check though, don't we? And that check is going to be for how much? Not for $87.71, but for the $8,000 that's in the bond contract. The face value of $100,000 times the stated interest rate of 8%. Cash is an asset. We make assets go down with a credit, and so we credit cash for $8,000. Alas, our journal entry doesn't balance. What are we going to do? We're going to plug the difference between our expense and our cash to our discount account, crediting it for $771. That's our plug account. We don't calculate that explicitly. We just let that number pop out of the journal entry. Now, crediting the discount makes it smaller, right? The discount carries a debit balance, so a credit reduces it. And the discount is a contra liability, right? It acts in opposition to our bond payable, reducing the amount of the liability on the balance sheet. So by decreasing the discount, we are in effect increasing the liability. Why do we do this? Well, what happened here? We calculated our interest expense as being $8,771. In our heart of hearts, we know that to be true, because we borrowed $87,711 from them when the market interest rate was 10%. There is no getting around the fact that if you borrow $87,000 at 10%, you're going to be owing $8,700 in interest. However, despite knowing this in our heart of hearts, we still only paid them $8,000. They said, "Give me $87.71," and we said, "No, here's $8,000 instead." And what did they say? Okay, that's cool. We'll just take that $771 you didn't pay us and stick it on your tab. Thus, the liability has increased by $771. It's been stuck on our tab. When will this $771 be paid? On the back end of the note, when we give them $100,000 in cash, despite only receiving $87,000 from them at inception. Let's fast forward to the next year. It's again time to pay interest, and we have to calculate our interest expense again. It's not going to be the same $87.71 we recorded last year, though. Why? Because the deal is we pay interest on the money that we've borrowed, and we haven't borrowed $87,771 from them anymore. We've now borrowed $87,771 plus what they stuck on our tab, that extra $771. We can see that by looking at the T accounts for the bonds and the discount. Our bond account still has the $100,000 in it, but here's our discount account. And our discount account started at $12,289. We put the $771 on the tab. We've now got a balance of $11,518. So the net book value of the note is now $100,000 minus $11,518, or $88,482. Alternatively, we could think of it as $87,771 plus the $771 that they put on our tab is equal to $88,482. So our interest expense will be $8,848. We'll book the interest expense, we'll pay our cash, and we will, once again, plug to our discount account. We will continue to do this through all 10 years, each year adding to the interest expense we recognize and decreasing the discount account. At the end of the 10th cash payment, the discount account should be all the way down to zero. And then when we write our check for $100,000, that's exactly how much we have left on the books in our bond payable account. Pretty cool, huh? Included at the back of your notes packet is the full amortization schedule for this bond, so you can see how to get to a net book value of $100,000 from where we started way back when at $87,711. Our car loans, or mortgages, represent a different kind of loan. Rather than paying periodic interest and then the principal all back at once, these loans are structured such that each payment pays off both interest and principal. The accounting treatment is the same though. Each period will recognize interest expense based upon the effective interest rate and the amount currently owed. At the end of your notes packet is also an amortization table for that sort of a note. Also, in the course folder, I have an Excel spreadsheet posted to help you create an amortization table for your home mortgage or car loan if you have one. Get your most recent statement and input the data requested, and it'll autofill the remaining life of your loan. Pretty cool. One last thing, bond retirements. The value of our bond is based on the interest rate the market wants in return for taking the risk of lending to us. If we've ever listened to the nightly business report, we may have heard something about bond prices going down or going up as interest rates change. As the economy changes, and as the firm itself changes, the interest rate demanded by the market for our loan is going to fluctuate. If we are looking to pay our bond off early, and the bond isn't callable, we're going to have to pay the going rate just like any other investor. This means it's most likely that the price we pay to repurchase our bonds will not be the same value as on our books. When this happens, we'll treat it the same way we did with our fixed asset disposals. Say we buy back our bonds after the first year for $90,000. We'll close out the bond payable account since we don't owe them that money anymore. We'll get rid of that discount account since we can't have that if we don't have a bond. We'll record the cash that we paid, the $90,000, and since our journal entry doesn't balance, we'll end up plugging, in this case, to a loss. We have a couple other long-term liabilities to be aware of. The first is when we sign a lease for an asset from someone for a long period of time. Now, the way the lease works is that we sign a contract with the lessor. They give us use of the asset in return for some periodic cash payment. These could be as short as renting a car for a weekend or as long as the 99-year lease on Hong Kong. The specific contract terms are up for negotiation between the two parties, and those terms will dictate how we account for the transaction. The first option is what we call an operating lease. This is our typical short-term rental agreement, and we will treat this as an expense when we use the asset. If we're renting retail space, we'll debit rent expense, and we'll credit cash as we make those payments, or perhaps debit prepaid rent, depending on the timing of the cash flow. Pretty straightforward. The other is what we call a capital lease. And we treat this as if we went to the bank, borrowed a bunch of money, bought the asset, and then made periodic payments to that bank. So we will debit the asset and we will credit lease payable, accounting for that lease payable like the installment note that I described earlier today. This includes recognizing interest expense based on the current amount of principal and applying the cash payment between interest and principal. The problem is, of course, that the observable action is the same under both of those. We make a periodic payment. So when do we have to use a capital lease? Well, the idea behind the capital lease treatment was that people tried to borrow money to buy an asset without recording the asset or the debt on the books. They figured that if they called the transaction a lease, it would just get treated as rental expense. This significantly lowballed the amount of liability the firm reported itself as having, and was an example of off-balance sheet financing. So the FASB created a number of bright-line rules that indicate a lease is a purchase in disguise, sort of like you might be a redneck if. This is a purchase disguised as a lease agreement, and so we're going to ignore the form of the transaction. What are the criteria? First, transfer of ownership. If we get to keep the asset at the end of the lease, we bought it. That's simple enough. Second, if we get to buy the asset for some trivial amount of money when the lease is done, it's basically the same thing as getting to keep the asset. We'd be crazy not to take the deal, so we're going to end up paying that $5 for the car, or perhaps $10,000 for the 747, some ridiculously small amount of money. So that would be a capital lease as well. The third rule looks at the economics of the asset. If the term of the lease is at least 75% of the asset's life, we've extracted essentially all the value the asset can provide. In that case, we treat it as if we bought it and dumpsterized it. The last rule is way more complicated than we need to get into. But the gist of it is that if we're spending so much money on this asset over the life of the lease, we may as well have just gone and bought it outright. So if any of these 4 tests are met, I'm debiting asset and crediting liability. If none of them are met, I'll simply debit rent expense each time I make a cash payment. Now, this doesn't mean that people haven't figured out ways to game the system and still avoid the capitalization treatment, but it's worth being aware that this stuff is out there. Also, the rules are likely to be changing at some point in the relatively, maybe not so distant future if the FASB ever figures out how it is that they're going to fix these rules. One last thing, pension liabilities. Firms have been moving away from the traditional pension with a guaranteed benefit to the defined contribution plan like 401ks and 403bs. If we've got one of these new ones, firm liability is typically limited to whatever matching they offer, if any, plus the payroll withholding liability we discussed earlier for what they take out of our paycheck as our own contributions. If we have a traditional pension, though, we're going to be using actuaries to determine the value of what we're going to have to pay. We'll also be tucking away money into an investment account so that it can grow to help meet those future needs. Pension accounting is very complicated. However, one thing we need to know is that when we report a pension liability on the balance sheet, that's not what we owe our employees in future benefits. That's the difference between the present value of those payments and the value in our investment account. In your notes, I have reproduced the footnote dealing with pensions from Citi's 2009 financial statements. Citi reported about $1.2 billion of pension liabilities on their balance sheet. That's a whole lot. But if you look in the footnotes, you'll discover that their actual liability to employees is around $11 billion. They've got about $10 billion of plan assets to pay for those liabilities as they come due, and it's the net of those two that they report on the balance sheet. But what happens if the market tanks and these plan assets drop by 20%? Well, now we're looking at, say, $8 billion of plan assets. But they still owe their employees the $11 billion in promised future benefits. They're going to have to be ponying up quite a bit of cash. So keep an eye on those pension liabilities. There's quite a bit of liability there to be aware of. Okay, some parting thoughts about debt. First, of course, read those footnotes and make sure you understand the terms of those debt contracts. If the firm defaults on a loan and it's been specifically collateralized, the rest of us could be in a rough shape if they decide to repo that factory. Make sure you understand the estimates behind the liabilities that you see. Warranty liabilities can be killer. Pension liabilities even worse. And if we've got a traditional pension plan, we're estimating a liability that we'll have to pay 20 years from now based upon estimates of life expectancy and the like. Third, understand that most debt contracts come with restrictions of some sort or another. The bank wants to make sure that we're spending their money wisely and that they're going to be able to get their money back. They may put restrictions on our ability to pay dividends or to expand facilities, and they require us to maintain specific ratio levels. Should we ever be out of compliance with even one of these covenants, we are in technical default and the bank can demand immediate repayment. Typically they don't, but it gives them leverage to renegotiate, and on average, this renegotiation results in about a 1% increase in interest cost. I had another example of professional shenanigans associated with this particular issue. The client was an industrial machine manufacturer that did a lot of custom work for clients. I was auditing their inventory, and I noticed the same serial number was showing up in inventory 3 years in a row. I went and asked the CFO about it, and he swore up and down that he was going to sell it any day now. I went and asked an engineer, and what did he say? Of course we're not going to sell it. That's our demo model we loan out to potential customers. Why the deceit? Because if they called it a fixed asset, they would have violated a covenant on asset acquisitions, and they would have gone into technical default. Of course, what happened? We let it slide anyway. It was the same partner as the other thing, too. Go fig. Anyway, these covenants are important to pay attention to. There are a number of ratios introduced in this chapter that we can look at. Debt to total assets is a revisiting of our current ratio from the past, but looking at total assets and debt rather than just the current portions. All debts do eventually need to get paid, so we would like to know that the firm has sufficient assets to pay this stuff off. The debt to equity ratio tells us to what extent the firm has chosen to finance itself with debt and with equity. While financing with debt means we don't need to split the pie with other investors, having too little equity to absorb losses can put us on the road to bankruptcy in an economic downturn. Debt is a good thing. If we can borrow 8% and earn it 10%, that's free money we don't have to share with other new shareholders. But there is such thing as too much of a good thing, debt included. Lastly, we've got the times interest earned ratio. Interest is non-discretionary. If we fail to make an interest payment, that's not the same thing as forgetting to pay the light bill. The light bill is a standalone payment. That's all we owe. If we miss an interest payment, though, the bank might demand all of our debt be repaid as well, and that's somewhere we don't want to be. So the times interest earned ratio gives us a cushion. If things take a bad turn, are we going to find ourselves unable to make our interest payments? If so, we've either got too much debt or not enough profits, or both. Next chapter, we'll look at the last chunk of the balance sheet, the equity section.